Chapter 3, Part 1, Accounting and Finance. Following are the learning outcomes from this part. In this presentation, students are expected to understand the details of balance sheet. They are expected to interpret information about assets and liabilities from balance sheet. They are expected to develop the ability to connect the dynamic nature of a balance sheet. Subsequently, we'll study and expect the students to develop the income statement of a firm and connect the income statement with cash flow statement. Cash flow statements is probably the hardest part of this chapter. So, what's a balance sheet? Balance sheet is a financial statement. A financial statement is essentially a statement that contains information about dollar flows invested in either assets or liabilities. So it shows the firm's assets and liabilities in dollar values at any given point of time. And essentially, whatever is the difference of assets and liabilities, the excess of assets that remain are given to shareholders. So the dollar amount that is in excess of the total value of assets and over the total value of liabilities is called shareholders' equity. Now, the balance sheet has assets. Current assets are assets which are more liquid. Essentially, that means that they can be converted into cash faster, such as cash and securities, receivables, and inventories. Fixed assets are harder to convert into cash. They take time. They could be tangible assets such as plant and machines, and intangible assets such as a patent or a trademark or a logo. They add up together to form total assets. And total assets, on the other hand, on the balance sheet, we have current liabilities. These are payables in the short term or short-term debt, such as commercial paper for a firm. Long-term liabilities, such as debentures, and whatever is left between total assets and total liabilities is called shareholders' equity. So the shareholders' equity and total liabilities equal the total assets of a company. Assets represent the uses of a firm's funds, and they show what is the total amount of current ownership of that firm into various things. Liquid assets, like we said, can be easily converted into cash. Current assets are more liquid than fixed assets. So examples of current assets are, well, marketable securities. Accounts receivable are also current assets. Inventories are also current assets. So the most liquid among these is marketable securities. The least liquid among these is, it could be inventories, because you have to go out in the market and sell them. Accounts receivable, well, you can just go to your customers and ask for your money. So marketable security is most liquid. Least liquid is inventories. Which of the following is a current asset? Property, production equipment, or unsold inventories? Well, since property and equipment are fixed assets, it's harder to sell them. So unsold inventories are easier to sell and therefore the current asset. Now, fixed assets are tangible or intangible. Tangible fixed assets can be felt, like plant and machines. Intangible fixed assets, such as patents and logos and trademarks, cannot be felt, but they are there and they can be sold for a dollar amount. Goodwill is also an intangible asset. Now, which of the following represent tangible assets? Well, which of these can be felt? First, property is felt. Production facilities is felt. Patents are not felt, so they are intangible. Production equipment is felt. Trademarks are not felt, so they are intangible. Copyrights are not felt, so they are intangible. What are liabilities? They represent the sources of firm's funding. So essentially, a firm borrows and creates liabilities. So that's the funds that the firm has in its hand now. So liabilities represent what a firm owes to its creditors. Current liabilities are easily have to be paid in the short term. Long-term liabilities can be paid in a period more than 1 year. And current assets minus current liabilities is called the net working capital. Working capital is the capital that a firm needs in order to manage its day-to-day operations. Therefore, its relationship with current assets and current liabilities should be noted. Now, which of the following is a current liability among these three? A bond debt maturing in 3 years, not current. Bank loan in 24 months, not current. However, in order to pay a supplier, you need to have funds less than a year. So these are current liabilities. There you go. Now let's start up a coffee shop. We have cash $700. Our balance sheet looks like this. We have cash worth 700, so assets are 700, and our owner's equity is 700. So total liabilities and equity is 700. Balance sheet is balanced. Now let's buy a new machine worth 500 using cash. So cash decreases to 200. Machines, fixed assets are worth 500, and owner's equity is not changed. It's 700. So assets are 700. Liabilities and owner's equity is 700. Let's go on. Now let's buy some raw material with cash for $100. So now our cash decreases further to, no, we actually bought it on credit. So our cash does not decrease. It remains at 200. But our raw material increases from 0 to 100. Our machines remain at 500. Now we have a liability. We're supposed to pay our supplier $100. That's called accounts payable. That's 100. Owner's equity remains at 700. So total assets are 5 plus 1, 6 plus 2, $800. Total liabilities are 7 plus 1, $800. The balance sheet is balanced. Now let's make 10 coffees using 10% of the raw material. So our raw material in the previous slide is 100. 10% of raw material is 10. So if we convert 10% of raw material, that is $10 worth of raw material, we're left with $90 of raw material and $10 of finished goods. That's exactly what we see here. So that's $90 of raw material and $10 of finished goods. Everything else is the same. So what's the total size of all the assets? 500, 10, 600, 800. Total liabilities is also 800. Now, if we sell all the coffees for $25, let's go back. These finished goods are coffees. We sell them off. Our $10 becomes 0. Our accounts receivable, which is a new asset, becomes 25. Let's see that. There we go. Finished goods, 0. So $10 is gone because we've sold it. It's become accounts receivable because we haven't received cash yet. So cash 200, raw material 90, finished goods 0, accounts receivable 25, machines remain at 500, and the liabilities are at 800. Now is there a problem here? Let's add up. 525, 615, 815. 100, 700 is 800. There's a problem, right? What's the problem? The balance sheet is not balanced. So what's going on here really? We have $815 worth of assets. Why did we have that? Because we have accounts receivable which is more than the finished goods. Why is accounts receivable more than finished goods? Because we sold our coffees at a profit of $15 a piece. And who does the profit go to? The profit goes to the owners. So we balance it by giving owners that $15 of profit. Now let's add up. 815 on the left, 815 on the right. That's how the balance sheet is balanced. Now let's go back to the original situation in which we haven't sold our finished goods yet, and we pay suppliers $50 from our cash. So our cash goes down from 200 to 150. Our accounts receivable. So we have sold it, but we haven't got paid from them. So our finished goods is 0. Cash has gone down to 150, and accounts payable have gone down to 50. So when accounts payable go down, cash goes down. When accounts receivable goes up, there is no change in cash. So what is the total amount of assets? 150 plus 90, 240, plus 500, 740, plus 25, 765. And total liabilities 50 plus 715, 765. The key takeaway here is when we pay off our suppliers, our accounts payable decrease and our cash decreases. That's the important part. Now let's receive $25 from customers. If we receive $25 from customers, our accounts receivable goes down to 0, and cash increases because we've got $25. So cash becomes 175, accounts receivable becomes 0, and the total size of the balance sheet is 175 plus 90, 265 plus 500, 765, and that's the case on the right hand side as well. So the balance sheet is still balanced. So the takeaway here is when accounts receivable decrease, cash increases. Now let's take a bank loan to start a new shop for $700, and this is cash. So we had cash of 175. It'll increase to 8. Well, here in this case, we kept accounts receivable. I apologize. So we have $25 of accounts receivable, and that's back to 850. Now it's back to 850 because we had 150 cash and we got $700 of new loan. So let's go back and see that. So here we have 150 cash, 25 accounts receivable, 90 raw materials. Here is where we borrow the $700. So the cash becomes 850. And now we have a loan here in liabilities, which is 700. So let's see that. Here we go. So there's a long-term debt for 700, and our cash has gone up by 700. The total size of assets is 850, and 90 is 940, plus 25 is 965, plus 500 is 1465. Again, the size of the assets equals size of liabilities and owner's equity. That's chapter 3, part 1. Thanks for listening.